una tarde más a invertir como un profesional. Aquí estamos en directo, un día muy especial. Tenemos una entrevista a Brett Kelly de Kelly Partners. La verdad que me hace mucha ilusión entrevistar a Brett, o sea, una compañía muy interesante. Ya sabéis que en este canal pues hacemos un esfuerzo para traeros a los mejores CEOs de pues las mejores compañías small caps. Hasta el momento hemos analizado pues más de, yo creo que 12 empresas, es decir, hemos realizado más de 12 entrevistas. Por tanto, seguiremos haciéndolo. Al final, pues yo estoy en contacto con muchas de estas compañías, por tanto, es muy útil hacerlo. ¿Sí? Por tanto, hoy toca entrevista. Estoy esperando que se conecte Brett, a ver si todo sale bien. Como siempre, hemos quedado a las 8. A ver quién tenemos conectado. Inversor Lucense nos dice buenas tardes a todos, con muchas ganas de ver qué nos cuenta el Brett Kelly. Ya sabéis que haremos un turno de Q&A al final, 15 preguntas para que 15 minutos, perdonad, para que Brett pues, pueda responder directamente. Tony, buenas tardes, ¿qué tal? ¿Cómo estáis? Confirmadme que se escucha bien el audio, si podéis. Georgie, buenas tardes, bienvenidos. Me podéis ir dejando los comentarios y si queréis los trasladamos al final. Sí que agradecería si, me confirmáis que el audio y el vídeo es bueno, ¿vale? Mientras esperamos a Brett, yo voy a chequear el audio, el email, habíamos quedado a las 8. Todo ok, gracias Carlos. Mañana aprovechando el directo de YouTube que hacemos siempre los jueves, pues aprovecharemos para ver un poco en detalle Kelly Partners, que probablemente es una small cap pues para tener durante muchos años, ¿no? O sea, la típica small cap compounder que todos conocemos. Mientras tanto, no sé si alguno tiene alguna pregunta, alguna curiosidad, mientras hacemos tiempo esperando a Brett, pues podemos comentar todo lo que queréis. A ver, voy a enviar un WhatsApp. Ok, ya lo veo aquí conectado. Le voy a dar paso a Brett. Brett, hello.
How are you?
I'm fine. How are you?
I'm terrific, thank you.
So I'm very excited about this interview because it's not very easy to find to the YouTube, to the channel, the best small cap CEOs. So I think this is a good opportunity. As for your knowledge, this channel I think is the only channel in south of Europe. They try to bring US, Australia, UK, Nordic countries to try the CEOs to talk about the business. And this opportunity is because, as you know, the private investor cannot go directly with the CEO. So at the end of the interview, Brett, I like if you can answer 10 minutes questions from the people. Okay.
Great. Easy.
So
I'll swap my...
why are you searching?
I'll get my background nice for you.
Okay, take your time, don't worry.
Put my man up there. And I'll put this over there. And off we go.
Okay, before I start, let me read the disclaimer first in Spanish and then in English, okay? Invertir como profesional no ofrece ningún servicio de inversión, no ofrece ningún tipo de asesoramiento financiero. Cualquier opinión aquí expresada por Brett, por mí, siempre es con carácter totalmente educativo y nunca lo debéis interpretar como una señal para comprar o para vender. Invertir como profesional does not offer any investment advice, does not offer any type of personalized finance and investment advice, and any opinion expressed here is just for education nature and should not be interpreted as a confirmation to buy or sell any security. Okay? So, Brett, thank you to come here. Let's discuss who Brett Kelly was before establishing Kelly Partners in 2006. I think Buffett, and at the age of 22, your father gave you a book, and many months later, you were in contact with more than 80 prominent people in Australia, right? So, and then later of that, you write a book. This book was a national bestseller, and later you did more than 200 conferences. could you summary this story and who was Brett Kelly before Kelly Partners?
Yeah, it's an interesting question. I think in a founder-led business, it's important to understand what drives the founder. And as I always say, it's good to start at the beginning. My father had a business, and in 1990, when I was 16 years old, he came home and shared that the CFO that had been appointed by a large accounting firm or sourced by that large accounting firm had embezzled money in the middle of a recession, and that had very badly damaged the business. As a result, I saw the impact on him and how much that upset him. And where I was planning to go and study law in England, I instead decided to go and take an undergraduate cadetship straight out of school at Pricewaterhouse and study accounting, because I always intended to be in business. And I was seeing clearly that that accounting was the language of business and that I really needed to understand it. So I went to Pricewaterhouse. I worked there for 4.5 years. I joined an investment bank where I lost my job. I didn't fit in with the other advisors. And I later came to understand that that was because where they were comfortable to advise, I really wanted to be doing deals in my own right. And so I don't think I was that suited to that type of work and didn't really fit in with those people. I also didn't share their values. And so that was never going to work out that well. You're right that my dad gave me 2 books, Think and Grow Rich and How to Win Friends and Influence People. And I realized that at university, you don't spend any time studying how to work well with people. And I think that's very unfortunate. What is true is that everything that you try to do, you need to do with people. And so being skilled at working with people is really important. And so I learned that from the first book. From the second book, Think and Grow Rich, it said, find people that have been successful and ask them what they did. Now, I was young. I didn't know what I wanted to do. And so I wrote a list of 80 prominent Australians. And said, I'm 22, I'm unemployed, I'm keen to learn. If you'll spend an hour with me sharing answers to my 11 standard questions, I will get out a book of those lessons for other young people. And so what I did was I pulled together the first of what is now 4 books. And I've got this one here. And this was the first book. And what I did was I profiled each of the people, and I asked them about themselves.
I think you received 40 calls from the 80 people, no? So more than half of the people, they answered you, right?
Yeah, I interviewed in the book 34 of those 80 people. I also got phone calls from a number of other people who couldn't be in my book because they had a publishing contract. And they were good enough to speak to me on the phone in those days because there was no video like this. And I learned a tremendous amount from those people. What I learned was that firstly, everything you want to do, you need to do with people. And that the money, the experience, the expertise, and the connections that you might need to move any project forward will really come to you to the degree that you are good at working with people. And so if you're good at working with other people, you can access experience, you can access expertise, you can access the capital. But if you're not, then your universe shrinks. So to the degree that you can work well with people, and the more people that you can work with and the more diverse that group of people is, then the larger the business is that you can build. Now, I then learned, in building the business that I believe that if the more people that you could work with, the larger the business you could build. And so that's really very important background. I went back into a chartered accounting firm. I did my Masters of Taxation. I became a registered tax agent. And by the time I started building the business in March 2006, really in its first conception, I was 29 years old, and I had, nearly 12 years experience in not only chartered accounting, but also in the production and marketing of my books and public speaking. I'd written my second book at that point. So the second book I wrote was this book called Universal Wisdom. And in that book, I actually wrote to Warrren Buffett, and he wrote a nice letter back to me in June.
We are going to talk later about Warren Buffett because I think you are a follower.
Yeah,
but
July 2006. So then I started the business in June 2006.
Okay.
And this book came out. When did
we talk later about
2005,
that.
I should say, 2005.
Because
so
I think
the book has been an important part of building the business.
Okay. We talk later about Warren Buffett, about books, because I think you love to read. So maybe at the end of the interview, you can recommend some names. At the same time, you're born in a family of 7 brothers. So it seems that your competitive style could be started when you was a child. So could you talk a little bit about that?
I think when you grow up in a large family, you have a sense of self-reliance that you might not have when you don't grow up in a large family.
Okay, let's starting with the business. So Kelly Partners is an accounting services business for small and medium caps. You write a manual, owner's manual, but before this manual, I think you write a book with the name of Your Money, Your Choice. I think it's related, but it's not the same.
Yep.
And you said that you was inspired by McDonald's business model and also for Walmart from Sam Walton business model. So could you talk a little bit about this first initial in the business?
Yeah, so when we started the firm, I realized in March 2006, my friend Scott asked me to help him start a firm. And I realized that accounting firms were not well run. They didn't work well, and they didn't work well for their people, for their clients, or the community. And so I said, we need to fix that. And so that's what we set about doing. We said that to fix that, you needed to look at the best businesses in the world, not accounting firms. And those best businesses, in my view, around people were Disney, around processes were Walmart and McDonald's, around clients were Four Seasons and Apple, and around financials were Berkshire Hathaway. So I looked at the world's best businesses, not accounting firms, and said, what can we do to create the things that they do so well? Now, what they do well is they are very well systemized. They understand, firstly, the reason that they're in business, and then how to deliver a consistent experience to their people and to their clients. And so that's what we set about doing. Okay,
great. I think you always said, I read these words from you in different interviews, that 80% of your work is people, right? So I think your main brain business model is related to people. So could you talk a little bit about that?
Yeah, I think it's important in anything. I learned through my first, experience with my book, that your ability to work with people is really the leverage within a business. So a lot of people will say, oh, we can leverage this or leverage that. But I just had the fundamental belief that I had worked in a business where I didn't feel like, in more than one business, where they were interested in getting my full contribution to do, to really make the difference that I could make. And so I was determined that we would pull together a business system that gave people the best chance to bring their best self to work. And so to do that, you need to create an environment first that's where people act in the best interests of other people, so they're not selfish, where they do the things that they said that they would do, so they keep their word. In our language, they keep their promises. And it's very important that people recognize that the team can do more than an individual. And so that basis of clear values, off a foundation of a clear mission to make private business owners better off and a clear set of values, that really creates an atmosphere that defines what people work within. And so I just believe that if you walk into a room and the music's very loud, it's probably a nightclub. And if you walk into a room and the music's very soft, or there is none, you could be in a library. And so you need to choose, and deliberately choose with real intention, what is the environment that you are trying to establish within an organization so that people can do their best work and be the best version of themselves. So if you want to run a nightclub, you're going to need a lot of bright lights and loud music. But if you want to run an accounting firm, you probably need a lot of great lighting, so bright lighting, not horrible lighting. You need bright walls, bright white, and you need a more contemplative, library-esque, energetic environment than that of a nightclub. So, I started at the beginning saying we need to think about the 5 senses that we have. What is it going to look like? What is it going to smell like? What is it going to taste like? What's it going to sound like? So that you could, how's it going to feel? So that you can think bottom up in terms of the human experience, because it's people that are in your business. Now, that's changed to a degree as more people work from home, or they work flexibly. But when our people work flexibly, I still say to them, be mindful and intentional about the environment that you create in order to do your work. So there's a great photo of Warren Buffett's office above his door. He's got Invest Like a Champion today, or a sign of that nature. And so your own space that you create in your office, at home, or at work needs to be human and give you the best chance of being able to do great work. Now, a lot of businesses over the last 15 years in our industry, they started to take people's desks and make them hot desks and this sort of thing. Whereas we've really always had this people first philosophy. If we want you to work with us, we want you to have your own desk, that you can create your own space to be able to bring your uniqueness to the business. Now, it sounds very zen and very weird, very strange for an accountant to think like that. But what we're saying is, we think most people have 2 times the value that most employers are realizing. And if we can start from the ground up and create an environment that they can be their best, then they're likely to contribute at a higher level. And that's worked extremely well, as difficult as that is to explain in words.
Okay, so you told that you put people in the front of your model. You want to attract the best talent, and I think this is the reason, because you create this own operator business model where you have partners and you share the business. No? Do you think to attract the best talent, the best people, this is the right business model?
Well, I think the word that you've shared there, is it the right business model? I think that in every major philosophical tradition, they talk about wanting the best for others, the golden rule, do to others as you'd have them do to you. There's no culture that I'm aware of in the history of the world that has survived for very long that didn't think that sharing was a better idea than stealing. And so these big ideas, ideas lead to actions, actions lead to habits, and habits are your destiny. So it's the big ideas that matter. So for me, I never wanted to get wealthy at the expense of anyone else. If you own a poker machine, in order for me to win, you have to lose. So we wanted to have a 51-49 situation with our partners where it was a true partnership, where we shared the economics, and that if we won as a group, our partners were winning with us. Now, similarly, as a listed company, we've been paying monthly dividends in the same way that we pay a monthly dividend to our equity partners. And all the way through the business, what we've tried to do is shared economics, clear alignment, a genuine partnership that when you're better off, I'm better off, when I'm better off, you're better off, because we think fundamentally that's a good, big idea. Now, most firms in our industry have been, frankly, founded on the sort of small, mean, and scared idea that in order for me to get something, I have to take something off you. And that's not true. So either you believe in a small cake that everyone fights over, or the ability to grow the cake and share the benefit. Now, we have grown from $200,000 in billings on the first day I opened the firm. My friend had 160 and I had 200. So we had 360,000 in billings. And today we've got, an annualized run rate of over $105 million of billings. And so today we're billing sort of $2 million a week. And then in the beginning, we were trying to bill $360,000 in a year. So we think that sharing has created a level of alignment, and that alignment has driven outstanding results.
Okay. This kind of business model, not the same, but if you search for this owner-operator, you can find many companies in Nordic countries, especially in Sweden. This is a typical business model that you can find there. So skin in the game, decentralization, this is the key of this business model. But how you ensure that all partners are doing the right in this decentralized model? So how do you follow it?
Yeah, you can't do a good deal with a bad person. That's a classic Charlie Munger, quote that I have taken to heart. And so if you think about the funnel of talent into your business, or deals into your business, or customers, anything else, we're trying to, with our funnel, rather than get people to join us, we're trying to get people not to join us. So if you don't share our mission, values, and vision, then we don't want you to join the business. We have a very simple way of thinking about it. If you're not a person motivated by making other people better off, then we want you to go somewhere else. And so by being very deliberate, like very hard about that, you hold high standards. So set high standards, hold high standards, and make it hard for people to get into business. Now, there's nothing much you can do that's better than selecting the right people in the first place. If you marry a drug addict, it's very hard to get them to give up the drugs. You've got to, at the beginning, think of every single person and continue to think of it today. At the beginning of a relationship, when you're hiring somebody or whatever you're trying to do in the business, think about that person as staying forever, and that you have to employ them forever, and that you don't have a get out. Now, I adapted this idea from this idea of, if you own a punch card of investments, if you only had a small number, so the idea of linking good ideas, if you only had a small number, a limited, you're not allowed to make more than 10 investments in your life, you would do through a very, very detailed investigation before you made that investment. Now, that's Munger. Steve Jobs says, when you've got one person in a startup company and you hire the second person, you just hired 50% of the company. So that's very important, and you need to put a lot of effort into that. So the way I have thought about it is, if you've only got a limited number of people, and that every person you add is a percentage of the company, you need to run an extremely rigorous selection process. So we have a 17-point documented rigorous selection process to make it hard for people to get in, because we know our best chance of having alignment is by selecting the right person. And the final way I sort of explain it to our people is, the most powerful person in the world in the last 2,000 years. So you got Munger, you got Steve Jobs, but the third big idea is, if you think in the last 2,000 years, the most powerful person in the world was Jesus. Now, Jesus, he's getting crucified. They're dragging him up the mountain, and there's him and there's two criminals. And when they've strung them all up, one of the criminals says, you know, you're God, take me to heaven. And the other criminal says, fuck you, see you later. Now, Jesus was either a great philosopher, a great speaker, and depending on your view of the world, he could even have been God. So what we have to remember as company founders and people who operate businesses is that we are not Jesus. You see, Jesus's conversion rate was only 50-50. Here he is on the cross, two guys, one says, take me with you, and one says, I'll see you later. So when you're hiring, you've got to understand that if that's a bad person, you're not Jesus. You're not going to be able to convert them into a good person. So we're first trying to find, is this a good person? Now, our definition of that is acts in the interest of other people, does what they say, and plays as part of a team, knows that a team can do more than an individual. If we can make sure that we don't get the bad people into the business, then we're likely to get very good people into the business. Now, that level of clarity around people selection is very, very critical to the business, and I'll explain why. Your photocopier can only do 30 pages a minute, or 40 pages a minute, or 50 pages a minute. It can only do a certain number of pages based on its technical specification. And it doesn't matter whether you cuddle the photocopier or you kick the photocopier, it can't do more. Whereas with people, Steve Jobs was once somebody's employee. He was an employee at Atari. He left because other people couldn't work with him. Nelson Mandela was a lawyer in a law firm. So exceptional people have first started off as employees many times in companies, but often those companies have failed to unleash their talent within the business. So if you really believe the ideas I've just shared, and you know how much a person, the difference a great person can make to your business is unbelievable. If you believe that, then you will be very careful and very deliberate about how you choose your people. Clear funnel, 17 steps, a rigorous process of getting the right people. Now, when you get the right person, you know it, right? You just know, because they can make a contribution far beyond the average person. So we're very passionate about the people piece. We believe in the dignity of people. We believe in wanting to give them an environment where they can do great work and really make a difference. And there's a lot of those people out there that are just struggling to find an organization in our industry that shares, those sorts of ideas.
As you talk about people and make due diligence to try to find the right people, I was remembering the last recent interview to Brad Jacobs from XPO, when he explained that he don't want to sit with the CEO, with the CFO. They want to sit with the blue-collar people, right? And they want to spend 1 hour with this kind of people to talk. What do you think the CEO need to improve to have a better business? So I'm so surprised about that, but I think this is more of the same, to try to understand the people, understand his reasons and his problems and his opportunities. Okay, can you talk a little bit how it works, the contract with the partner? I understand that these are long-term contracts, maybe at least 10 years, but could you some example with any last transaction, but for a better understanding of the people, how it works, the contracts?
So we believe that relationships are best formed with people that you want to be in a relationship with forever. And so on most people's wedding days, when they stand there and say, I do, in front of 500 friends, well, hopefully there's a few friends there, everyone believes in lifelong marriage on the day that they get married. Later, people change their minds about their own core values. And so with the partners in the firms, I've only ever wanted to recruit into the business long-term people, what we call long-term people in a short-term world. So most people today are very transactional, very short term. Whereas our clients that are successful family business owners, they want to have an accountant for 30 years, not 3 years. So it's very important in our business model that we match up equity partners with clients on a long-term basis. Now, I typically say to people, would you like to be in the business, if you come to Kelly Partners or you become a partner, would you like to be here long-term? And they all say yes. And then I say, well, how long do you have in mind? And they all say 3 to 5 years. So I say, why don't I ring your wife and tell her that the long-term contract you have with her is 3 to 5 years. So at Kelly Partners, with our partners, we're talking about marriage, not dating. And so that's very important. We have a 10-year agreement, and there's very specific provisions to that agreement. And it's very detrimental to a partner to leave financially before that 10 years.
So, if some partners want to broke the agreement before that time, they have to pay something to Kelly Partners?
So I prefer not to share some of our secret sauce, but they are very much worse off financially should they attempt to behave like that. But you'll be worse off if you attempt to leave your marriage when you said that you wouldn't. And so for us, because our number 2 core value is keep your promises. If you promise to be a long-term partner and you breach that promise, it will cost you a lot of money, as well as a few other things. So that is enough to scare away a short-term minded person. Because when they see our agreement, they say, hang on, I'm not sure if I want to be here long-term. And I say, no problem, just don't become a partner until you are sure. So, good courtship, good dating gives you good outcomes. And then at the end of the 10 years, they have a 3-month notice period where they can tell us whether they want to renew or not. If they don't want to renew, then they need to organize an internal succession for their equity. And if they don't or they can't get paid for their equity. And then there's every type of non-compete and all the rest of it around the agreement. So the agreements have been structured in a very sophisticated way, reflecting a clear set of values that reflect what we think is good for people, as well as what's appropriate for the clients in terms of the business model. The reason that our business works, in my view, is that what we're asking people to agree to is their highest values. So when you're standing there, Quim, and you're getting married, and your wife says in front of the priest or the rabbi or the mufti or whoever is officiating, hey, you two, how long do you expect to be married? Normally you don't say, well, maybe I'll give it a go for a couple of years, 2 or 3 years, and then we'll reassess after that. If you're still assessing, you shouldn't be getting married. So that's the ethos that we've got. It's very strange. It's completely different. We now have 90 equity partners, and we're just trying to, grow a group that has a particularly strange set of values that we think are very appropriate and advantageous in this modern world.
So you share the profits with your partners, right? They gave
51.49. 51.49.
You have 51, but you have a fee of 9% that the partners pay Kelly Partners 9%, and you said that you are to reinvest all this money with the partner. Is it how it works, right? So it's like an operator business, and some likes a franchise business. Is it an hybrid model, right?
Yeah, so I saw the benefits of a franchise system and then the benefits of a direct equity system and sort of combine them. So the 9% service fee is 6.5% services, 2.5% IP, and the firms pay that fee for us to run their businesses. The client directors, our partners, work on their people, clients, and leadership, community leadership. We really run the other 9 parts of the business through a central services team. That takes a lot of pressure off partners, gives them a lot of their time back. And that fee, we spend 100% of that. In fact, we've spent about an extra 5 million over the last 5 years out of our share of profits to continue to grow the business. So it's not a profit-making exercise, it's an investment exercise. But what it does, which is very different from our industry, is it forces the partners to continually invest in strengthening the businesses. And so most accounting firms everyone's taking money out, but no one's reinvesting. If you think of a company, it can retain profits. If you think of a partnership, it has to pay out its profits. So because they have to pay out their profits, the partners never reinvest in the business.
Okay. Well, there are many different business models in this business. So as you know, you have one of the competitors, not directly competitor from you, but in Europe, there are one company who is Telenom that I know really well because I spoke many times with Otto-Pekka Hutala, who is the CEO and the founder. And right now they are expanding in Spain. So I have the opportunity to talk with Spanish managers, and it looks really interesting. I think they are really software advanced, but we can talk later about the competitors. So Kelly Partners grew revenue from 27 million Australian dollars in 17 to more or less 19 millions at the end of 2023, with normalized margins of 30%. This more than 20% compound annual growth rate in revenues. Then we can talk about the margins, because I have maybe a more difficult question for you here. But it seems that the way to room is really high, because the total addressable market in Australia and in the US is really high. You talk about 12 billion, but could you talk a little bit what is the next step in terms of revenue growth for Kelly Partners?
Yeah, so we have always had this double mindset. And that mindset is that we have doubled the business every 3.2 years, 6 times in a row. And so if we keep doubling the business, growth solves many challenges. And so the principal challenge that it solves is it offers opportunity for our best people. The second thing it does is give us the financial resources to be able to strengthen the businesses. And then the strengthened businesses have an ability to grow even more strongly. So you're creating this sort of mission and fuel type flywheel that just keeps galloping along. So we don't see any barrier to continued revenue growth. We believe we can hold our margins and become a significantly, larger business over time. Our aspiration is just to keep helping people, and to the degree that we can make the owners of accounting firms better off, so to have more time to be healthier, wealthier, and wiser, then we think that there's an unlimited opportunity in terms of runway here in the US, in Australia, in the UK, and in other places.
You have a goal to reach one of the 100 accounting business in Australia. You are close to this target. So my question is more, okay, when you reach that, what is the next? So to scale the business out of Australia, or to be more aggressive in Australia?
Yeah, so we think that at the moment, if we look at it, we're number 21 in Australia. On a run rate basis, we're closer to 17. If you take away some of the firms that are not accounting firms, they're financial planning firms or insolvency firms, government consulting firms, of the sort of traditional tax and accounting businesses, excluding the big four, we're probably the 11th largest firm in Australia, and growing significantly faster than other groups. So we think that we can be a top 10 firm in Australia imminently. And at the same time, I'm now based 3 out of 4 weeks a month in the United States, in California. And I'm building a team here to grow this market, where we expect to be able to go quite deep in the market here rather than just wide, and then ultimately grow into the UK. The reason that makes sense is there's no Australian global accounting firm, and the large expatriate communities of Australians are in London, LA, and New York. So we'll try and grow that spine, if you think of it, and then grow out from there. We'll stay largely to English-speaking countries unless we can find partners who are excited about growing the business into other markets. We do have a model that we expect we can announce soon, where we can take a management team that wants to grow our network in a region, and we can fund and coach that management team to build our system into that market. And I'm very excited about the prospects of that. So we really don't see, we're not in a rush, and we don't see any sort of, anything that can stop us over time if we continue to act intelligently and rationally from growing the business globally.
So before to think in the US and in United Kingdom, so I was reading that in Australia there are more than 32,000 accounting companies where only 100 has more than 100 million. So the competitive environment is really good for a company like us that can grow organically 5% if you mix price with volume, and then you can buy small competitors. So I think you have many years to grow just in Australia. So you talk about English speaking countries. I suppose to go out of these English speaking countries is many 10 years later from now, right? So could be a
if you look at the German group. So the German group ETL, they have 1,250 accounting firms, and they're privately held, and they have a 50-50 model. They have 850 firms in Germany. They have many firms now in Spain, and they've built about £100 million already in the UK. But they're Germans, and they're largely focused on Europe. They've been doing what we do for 50 years. We've only been doing it for 17, but I have met with them. They're a very good group. We don't see ourselves as that dissimilar, although we're much more profitable. So we know that it's possible to have 1,000 accounting firms. The reason we know that is because there are other firms that already do, like ETL. We think that there's support within our team and our client base and our shareholder group to help us to grow. And the US market, you're quite right, there are 32,000 firms in Australia. There are 450,000 firms in America. And so today, we think that if we've done about 80 deals in Australia, if we did the same number over the next 15 years, proportionally, it'd be 15 times that number. It'd be, over 1,000 firms. And so we're not concerned that there's not plenty of growth. There definitely is. It's about growing in the right way, keeping your noble mission at the top of your mind, making a real difference to our people, our clients, and the communities that we work in. And if we keep that and build from the bottom up, so mission, values, vision, strategy, structure, keep that foundation and build, we're very confident that there's long-term opportunity. I've never been more calm about the opportunity, and I've never been more determined and energetic about pursuing that opportunity.
Okay, I don't know, Brett, if you have your own accounting software or you are using a third-party software. So what do you use and what the partners can choose?
Yeah, so we feel that the road that Talanom are taking, for example, is going to be very, very, very difficult. I don't believe that I can be a software company when I'm competing with companies like Intuit and Xero and Microsoft, etc. What I do believe I can do, as Michael Porter suggests, is that I can combine activities in a unique way to create a customer experience that other people can't duplicate and create value by using best-of-breed software in a uniquely organized system. Now, we do have software engineering talent working in the business now, and we are growing that technology capability. But our focus will be really knitting systems together, building robots and automation, and doing the things between the systems that can give us the most leverage. The benefit is I can't compete for software coding talent with Facebook or Google or anyone else. And so when you look at a software company, they've got to get enormous to be able to compete for talent. Otherwise, they're going to be very challenged in the future. So we don't think that software in and of itself is an advantage. We think that in the future, every company is a software company. That's a Mark Andreessen quote. And we believe we've got to invest in software, but only where it really customizes what we do and adds definitive value that no one else can add will we bother to build software.
This is a big difference with Talenom. So Talenom is one of the unique companies in Europe, also in Finland. They have their own software. They developed it 20 years ago. Right now, they are developing the second version of this software, and they are growing with the software. I think 90% of the tasks that managers needs to do in the business is automated. So this is also increase margins. They have some commercials that join the software, so they mix automated software with commercial, and they are growing too much here in Europe, right? So maybe the key is I put the people in the middle, and that people use some tools, and then I put the tool in the middle, and then I have people in front of it, right? So
yeah, that's what we find. Like if we walk into an accounting firm and say we want to buy this firm, but we tell them that you have to change all of your systems to our system. There's a couple of problems that I see with that. Firstly is that it's easy for that firm that you're buying to feel that you're motivated to sell them your software. And secondly, accountants don't like change, and there's no accountants in the market. So if you ask them to change systems, they're just as likely to change firms and leave. And so there's two ways to grow, organic and via acquisition. We think we can do both. We think most of the best clients live within existing accounting firms, and that the cost of actually acquiring them organically is huge. And so we're trying to pursue a bird with two wings. We think that you can grow organically and grow through acquisition. Now we'll build more and more software over time, but I think you can see Talenom's got any model like that where you're in the client service business as well as a software business. I don't think it's easy, particularly where you get into a situation where you're doing it in very many languages. I just feel like it gets quite difficult.
Okay.
But I could be wrong.
Your organic revenue growth across the history more or less is 5%. 3% is price, 2% is volume. Do you have some official guidance in terms of revenue growth?
Yeah, 5%.
5%. So this is right. So do you expect along the cycle to grow 5%? Is it right?
Yeah, we think 5% is good, and we think we can add 5% to that. That's acquired growth. So if you've got a firm and it's doing 5 and 5, it's growing 10% a year. It'll double. It'll double every 7 years, 7.2 years. That's okay. We think generally we can do better than that. Our cumulative average growth rate over 17 years is 30%. So we've proven that we can grow faster than that, but it doesn't help to put pressure on people to grow. The wonder, the real wonder of our model is that it can accommodate a 65-year-old who just wants to grow at 5% a year and a 35-year-old who wants to grow at 25% a year. We don't mind as long as they grow at 5% or more. And it's not always, everyone's got their own age and stage of life. They're not always able to just do what everyone else is doing.
Can you talk a little bit about your OPEX and your CAPEX? So which part of this OPEX is fixed, which part is variable, and then talk about the CAPEX, just for a better understanding of the people.
Yeah, so look, we think of the business as essentially having, little to no OPEX and little to no CAPEX. So the CAPEX is just fitting out offices. A lot of the actual CAPEX, in my view, isn't covered as CAPEX under accounting standards. So when we're investing in new software, new websites and branding and this, that, and the other, there's a lot that's expense that has many, many years of value to deliver. And then in terms of OPEX, we've got working capital, and that's about it. There's not much more to these businesses. If they're run well, they're pretty simple.
Okay, can you split it if most of the OPEX was fixed or variable? Or?
Yeah, most of the OPEX is simply working capital. If you think about the business, you have to pay wages, you've got to pay overheads, and then you've got to fund clients that owe you money. That's it.
Okay. How do you feel about, this is a question that I have many questions in YouTube and also in Twitter. I always think that free cash flow is later and before acquisitions. How do you feel about free cash flow? Do you think it's some number before what you do with that money? Or do you think it's a number at the end of the uses of the money? It's a difficult question, I know that.
Yeah, look, I think people get really confused and technical and hung up. I think of cash flow as free cash in the most simplistic use of those words. So you can't pay your bills with work in progress and debtors. You can only pay your bills with cash. Now, you can't pay your people with hopes, dreams, and aspirations. You have to pay them with cash. So, like a banker would think, in my view, is that the cash I'm interested in is the cash net of all expenses, net of all taxes that can actually be used to grow the business. So, and then I'm really with, William Thorndike with the Outsiders is you've got some questions as to what do you want to do with the cash? So, I guess I'm saying that the cash flow I'm interested in is net of all of its uses. So post-acquisition. But I don't, you hear Charlie Munger say EBITDA is bullshit, but EBITDA is not bullshit in a growing business when you're John Malone. I think John Malone, and it would have been great to hear John Malone and Charlie Munger talk about that.
Totally agree here, because if you are converting this EBITDA to cash, you have an average converting cash of 80, 70%, 90%. This is real cash, right? So
that's right. So I've just looked at our numbers that we'll release next week. And our cash conversions are 100%.
This is a tricky thing for roll-up companies, because I see many times that I'm going, for example, like your company, right? I'm going to grow organically 5%, and then I'm going to grow 5% in making acquisitions. So I'm going to grow 10%. But when you see the free cash flow line, they exclude acquisitions. And you are growing 10% because you are expensing with the acquisition. So you have to take out of the free cash flow. Well, just a curiosity. So in the recent years,
I think of when I just think very simply like an accountant on a cash basis, not an accrual basis. So if I buy an asset, the way I've always thought is I buy an asset and I want the cash from that asset to pay off that asset. And after that asset is paid off, that's free cash. And that's a classic Buffett aphorism, right? He says, once I buy an asset and it pays itself off, then the cash from there is free cash. So the way I've always thought about our group is I don't think of it as a roll-up, firstly. I think of it as an active investor. So we invest into a subsidiary, so a special purpose vehicle, and with its cash flows, we increase its profits and we increase its effectively stock turn, cash time turn, so that we're generating more cash. There's a much higher cash conversion and we're paying off that asset. So once there's no debt on our interest in that asset, the cash that then comes up to the holdco is free cash in the truest sense of the term. So if I am looking at that underlying business unit and there's the organic piece, to your point, and then there's the acquired piece, the same principles apply in that this is generating cash that can go either to the headco or it can go and contribute to paying off the new growth, right? But they are just little cash boxes. And so I feel like, my focus has always just been on a cash return. And I take your point about roll-ups because the accounting can get very confusing. There's money moving everywhere. But fundamentally, if you buy an asset, you've got to improve its margins, improve its prospects to grow, and pay off the debt that you've used to acquire that asset if you've used debt. And then if you haven't, you've got to get a sufficient cash return against the equity that you put in to measure, to invest beyond the cost of capital so that you're creating economic value, which I frankly think is the bit that is missed the most.
Okay. In terms of capital allocation, when you talk about M&A, you are going to finance all the M&A with debt. So in the recent years, you are increasing your debt. Right now, I think you have 49 million Australian dollars if you exclude the capital leases at the end of June 23, where 37 is a term loan, you have a revolving credit facility of 11, and you have some secured debt. So do you have any target in terms of debt in the strategy? So some limit that you said you don't want to pass?
So we will gear the initial asset to the degree that a bank will let us. So it could be 50, 60, 70% of recurring revenues. But we will aggressively pay down that debt. And then what you've got is a portfolio of assets, some that are more highly geared than others. And over time, the gearing level tends to, what you've mentioned. So if you've got 37 on 110, maybe you're at 35% gearing, which is very comfortable against those recurring cash flows because the clients are going to come back each year and you're going to increase their prices. So you don't feel too stressed about that. Now, if you were Buffett, you could have no debt, but I couldn't have bootstrapped the business from scratch with no debt. So I think the key thing is your return higher than your weighted average cost of capital? And in our case, it is considerable.
Can you talk a little bit about your capital allocation strategy after acquisitions? So you are paying a dividend. I think your payout ratio is 50-70%. It is the average. You don't like to manage buybacks. So what to do with the real free cash flow? What's the strategy here?
So in Australia, dividends are very tax advantaged, and the investment community, because they're mostly older people, are very keen on getting a dividend. I think the dividends put a level of discipline, financial discipline, into a business because it forces people to look around for actual cash, not hopes, dreams, and aspirations. However, a lot of our large shareholders are now not Australian-based. They're global investors, and they're asking us to stop paying the dividend and to start investing that in further growth. It's likely that we will definitely do that sometime between now and the end of 2024, maybe sooner. But we certainly are not, we increase the dividend at 10% a year every year for the first 5 years. I don't expect to continue to increase the dividend in that way because we've now built such a good reputation that the deal set in terms of opportunity available to us is huge. And so we're going to need the capital to execute on the opportunity set.
Are you open to some buybacks in the future if for any reason the stock prices go down too much? So this is an option?
Yeah, so at the moment, we don't have enough free float to buy a significant amount of the stock back. So if we bought too much of it back, it would make the business that is a listed business even more difficult for investors. So often professional investors are saying to us, Brett, we can't buy a meaningful stake in the business because there's not enough free float. And so we have to balance, what is ultimately in the long-term interest of the business, having an appropriate level of free float listed on the market, is the right thing to do at the moment. That said, if we were to do, if I was convinced we should do a huge buyback, you'd effectively leverage the company and do a take private. You'd buy the whole company. So, there's a balance. I think as we get a better structure and are in a situation to stop paying dividends, ultimately I think we will find ourselves in a position where we've got plenty of cash, and if the share price is at the sort of levels that it is today, then we'll go and buy much of the stock.
Can you explain, Brett, who is Australia frankly dividend? Because many people don't understand that for the vocabulary.
So we pay 30%. We pay 30% corporate tax in Australia, and so when the company pays that tax, if you're a shareholder and we send you a dividend, the tax that we've paid goes with the dividend, and so you get a credit for that 30%. Now, many retired Australians are only paying 15% tax in their superannuation 401k plan, and they actually get a refund for the difference between 15 and 30. So they're very keen to see those franked dividends, they're tax-paid dividends. But, the point of us paying the dividends when we listed the company was to be able to prove to investors the quality of the business, which I think we've done, a very good job of. So now there's less of our investors who want to see a dividend. They would rather us significantly grow the business.
Okay. Can you make a summary of the last earnings results and an outlook for 24?
Yeah, so we will have results out next week soon, next week or the week after. I have to check the date. We were talking about that yesterday. I think we might bring it forward. We'll see what everyone thinks. The accounts are done. I've got a copy sitting there. The business is in very good shape. We continue to grow strongly. Strong margins, a huge opportunity set. We bought the first two firms here in Los Angeles. I'm convinced that there's a huge opportunity here, and we'll be able to continue to buy many firms here while continuing to grow in Australia. So we're in a good place. Good time to be an accountant.
Two questions here. One is you expense too much money in the last acquisitions, and second question is can we expect a recovery in margins, and what happened because the last margin was a little bit small or lower than the average or normalized margins? Can you explain here?
Yeah, so our EBITDA margin at the practice level will return to 30% or more. We always have a portfolio of companies. So when we buy a company, it takes time to improve their margin. If we buy a lot of companies, it takes more time because we can't do them all at once. But we will buy them when we can buy them rather than wait, because if you don't buy them when they're available, they don't wait around for you. So the margins, I don't see any pressure really around margins at all. That's just our ability to improve the businesses as we buy them. So that's in good shape, and the rest of the numbers look great. The gearing's down a little bit. The profitability is very strong. Frankly, I think we're very, very well positioned to continue to grow in a very interesting way to have real impact.
Brett, two difficult questions for you. One is you always talk about EBITDA margins, but as you have a big minority line, some people that said that you should to look at net income margins, not EBITDA margins. What do you say to these people?
Well, they can look at whatever they like. Doesn't actually worry me in that. I think the bit people miss is that I started the business with $200,000 of billings, and my own capital has compounded at over 60% a year, 60, for 17 years, nearly 18 years. And I've been in the accounting industry since I was 18. And I was the kid who came first in all the subjects. I was a smart kid. I wasn't a dumb kid. And the only thing I think about, other than my wife and children, is this business. And I've been thinking about this business for 17 years. I am blessed to have access to some of the smartest people in the world, in our industry and outside, and in our register in terms of our share register. And so while I understand why people have a view, I think we've built a company, and we're building a company that proves that we understand the business that we're operating. Now, from an investor's perspective, it's very rare that they meet a chief executive that has grown their business from scratch and is offering to do for other businesses that they acquire things that they've already done for themselves, and that has a tremendously deep understanding of the core operating functionality of these businesses. So I don't think about, should it be NPAT? Should it be net? I think about net profit. Okay, that's what I think about. I think about net profit per share. I think about a cash on cash return. I think about earning returns higher than our weighted average cost of capital. And I think about doubling the business consistently, what I call double, double, double. So double it again. So, I would want anyone looking at the business to understand that we've got a very intelligent, hardworking group of people with great values who really think about this business. Now, if they like to look at our numbers as net profit, no problem. If they like EBITDA, no worries. I think that there's enough in our accounts to make, it clear that we're very transparent about our numbers, that we're not trying to hide anything in our numbers, that we're very honest people, that we do what we say we're going to do. I think those things are likely to result in good results over time. And frankly, our continual acquisition activity means that the earning power of our businesses is not that obvious to people. But if you take 100 million of revenue, and you make 30% on it, that's 30 million of earnings, and you've got to pay some tax at 30%. That's 20 million net, and we own half of it. And so sometimes we're going to invest a little bit more. That's fine. We'll invest some of our profits. And when we do, I'm thinking about the 20-year growth. I'm not thinking about the 20-minute growth. I don't mind. Now remember, half the profits I own, because I own half the stock. So it's not like I'm doing one thing for me and a different thing for you. Yeah. We're very aligned as shareholders. I do appreciate the comment. Like I understand why people think that. I don't think they're wrong, but I have a 5-year view. If you look at our results over the 5 years, 17 to 22, we're now in our second 5-year period, 23 to 28. I think we'll do okay. We did 65, 85, 105. If we grow at 20% a year, as we've been doing since we IPO, we're going to double every 3 and a bit years. And so the business will do 100, 120, 240, 480, 960. That means in 10 years' time, you've got nearly $1 billion of revenue. That's a pretty good business. Now, if we only do half as well, and we hold our margins, EBITDA or NPAT, doesn't matter. You've got to have one to have the other. Then it'll be a significant business over time, But it's a good question.
Brett, the way that you set up the business when you was young, I remind me Eric Landon from RCA Hospitality, that he make a loan for $100,000 and he started a business. So there are different, or Bank of the Ozarks, they do the same. So I think the loan was bigger, but there are many stories of this in the US. So, okay, I'm going with the last questions and then 10 minutes with Q&A. Is Brett Kelly a critical intangible asset of Brett Kelly?
Look, I think all of us add some value, but I think people miss the quality of our system. I'm not doing everything. We have a team of equity partners. There's 90 of them. I think it's very disparaging to suggest that, those 90 people aren't contributing tremendously to this business. They are. I would like to think that we've set up a business system in the mold of McDonald's that can continue to grow whether I'm here or not. Now, I've moved my family and myself from Australia to the US in January last year. So I've been here a year. I go back to Australia for a week a month. I did 8 trips last year. The business continues to function and continues to grow. Now, short of me leaving the business and just sitting back and letting it grow, I'm not sure what I can do to convince people that, it's pretty, look, I think it's pretty helpful to have me around. My heroes are Mark Leonard, Constellation Software. I think Mark adds value at Constellation, but I think the business is bigger than him, and I think he'd say that. Bernard Arnault, LVMH, I think he contributes to that business. But the business, I think, will continue if he wasn't there. Obviously, Warren and Charlie, Berkshire's continuing, even though Charlie's died. So, yeah, I think we're all important, but, the world continues to spin if we're not here.
In your opinion, Brett, which one is the best metric or the best way to value your company?
So I have a view which is different to other people's view, that in order for a professional services business to thrive, it has to provide opportunity to people. And so a strong revenue growth rate is very important. But, and this is a very big but, right? Big but, I say that knowing that I will not do business where we don't keep our P&L margins and our balance sheet discipline. So if you bill at, and grow at 10% plus a year, and you keep working capital at 50 days, and you keep EBITDA margins at 30%, then the one number, I call them sort of the holy trinity. The number that drives that, you've got to, is you've got to grow revenue to grow opportunity. Now, the bottom line number, after I have those three things, the holy trinity, that's divided by the number of shares on issue. And if there's one question I'd ask a CEO if I interviewed them, it would be, how many shares do you have on issue?
14 million.
Well, we have 45 million, but most CEOs, they don't think about that because they're always just giving shares away. So our long-term prospects for return to our investors, we've got to hold revenue growth while we hold working capital discipline and we hold our margins, and we've got to not go around issuing a ridiculous number of shares.
Okay, go with questions. Inversor Lucense is talking that you are a follower of Mark Leonard, that you said, and Warren Buffett. And he asked about what multiplies, like EV, enterprise value to EBITDA, PE, you consider correct when making an acquisition, and what was the critical criteria for qualitative things when you think in acquisitions?
So the most important thing from a qualitative point of view is that you have somebody that wants you to succeed, that you're doing a deal with. So if you buy a company from somebody that thinks they're so smart that they want to prove that you can't run their business better than they could, or even as well as they could, then that's a disaster. So that's the most important thing. And then the price you pay, I only think about cash on cash payback period. I don't think about EBITDA to EV. I don't care about any of that. I don't think about those metrics at all. I just care about, if I put out $1, when do I get my dollar back? And we have a very high bar around the use of our capital, and I want that payback period to be as low as possible.
Okay.
Zero is the best.
The same investors asking about the dividend, is going to continue, or you prefer to decrease and reinvest more? So
yeah. So the answer to that question is, I expect that by the end of 24, we will have ceased paying a dividend if we can get the structure sorted out the way that we are hoping to do.
Okay. Well, there are many people like Pablo who said, it's amazing that can I ask it directly to Brett. So Pablo Alfredo Villarino is asking about, is it a risk, a threat, the AI, so the artificial intelligence for your business? Do you think is it an opportunity, is a risk?
Well, I think it's an opportunity, frankly, because the number of people that are studying accounting has fallen by 50% in the last decade. And the number of those people that are coming into public accounting has fallen by a further 50%. And so any tool that makes it easier to do what we do is going to be extremely helpful. I think AI is one of those tools. Now, everyone who is selling software or any new idea always tells you that the whole world is going to change. And change is a constant. Our industry has always changed. My whole life it's changed. But, I do think we need to understand that the people who are selling us the tools are telling us it's going to change everything. I still believe that the type of client we look after, a complex client, is going to have a high degree of need for the advice that we offer. And because governments are going to tax people more and more and more, they're going to need more and more advice. And I believe that the willingness of governments to tax is going to rise faster than AI's ability to help us with the problem. So yeah, I see AI as an opportunity. And I would caveat that I think it's a threat to small firms. I think it's an opportunity to a larger firm like us. Oh, you've gone muted.
Pablo is also asking about how do you feel about the expansion to the US later than 2 years, so 10 years from now?
I think we'll be a very large business in the US.
So you think you can scale the business there in a reasonable time, or?
Well, it depends what you mean by reasonable. I always think in 10-year periods. I think we can have a very large business in California within 10 years.
I have a UK company in my portfolio that is more or less in the same phase. They have, maybe you know that, is a leak detection company who the name in the US is American Leak Detection. So this is a national brand. So if you have a leak, maybe you have to call to American Leak Detection. And right now they are going out from the US and they are entering to Australia, UK. So this is more or less in the same. They are using franchises. They are not using partners. But so the opportunity is really big. So Marcelo is asking, so people is the key business of your business model. You talk about how you measure talent and how you talk about the employees. Are you separated the best employees that the worst employees? So do you have something to try to identify the best employees in the company?
So we have developed a number of tools that allow me to profile people against a set of criteria developed by a clinical psychologist who's an expert in positive psychology. So we test the person, and that gives us an insight into attributes that we know help in our industry. But what we've done is we've taken the most successful people in our business over the last 17 years in each of these key roles, and we profile new recruits against those best performers. And what that does is it allows us to take a view up front of the raw talent. After we've done that, or as part of the process, even before we've done that, we're just trying to work out, is this a person that is for others, keeps their promises, and knows that a team can do more than an individual? So it's a value screen first. We're very good at looking through where people have been and how they've behaved. And then we're using these proprietary tests to try and look at who they are. What that gives us is a sense of, a way to funnel the talent that I think is very, very unique. We understand people. You can probably appreciate, given the books that I've written at a very young age, I met a lot of people and we've got some very significant understandings of people. And so we're very, very good at choosing people.
Okay. Tony is asking about how is going the US listing process. Is something that you are right now, or maybe it's a future thing here?
No, so we've done all of the work on a US listing. We know that it'll cost about $12 million, and we need to build the business to a degree that we think that that level of investment makes sense in the context of the market cap of the business today. We think the market cap of the business should be considerably larger than it is today, and when it is larger, then we will or I expect that we will pursue a US listing.
Okay. Jose Luis is asking, why is better to pay a small dividend instead of reinvest this money in the company?
In the first 5 years, it was better to do that to demonstrate the cash generative power of the business. It is now no longer better to do that. And so very soon we'll stop doing that.
Okay. Okay, so Brett, I think we are on time. So if you want to summary with 1 minute, or how do you want to conclude this interview? I think could be interesting because there are real private investors that they follow your company, but this is a good place to pitch your company, to gain visibility in Spain and also in Latin America. So just a few words to finish this interview.
Do you know how most people have an accountant, but they know that that accountant doesn't give proactive advice, isn't accessible to them when they want them to be? They don't know that there's a system of giving them that work that can help them get from their goal to where they want to get to, and ultimately they know that the life that they're trying to build and the change that they're trying to make is not supported by that accountant. So if we all know that we've got an accountant that looks like that, is it possible that we can build a firm that gives proactive, forward-looking advice in a systematic way, where the partner, the senior professional, is accessible to you 24 hours a day, 6 days a week, and really cares about you, and actually wants to change your life? You know, fundamentally, we have built a business system that at a ground level delivers that to our clients. We've got a very high NPS. We've got the lowest measured staff turnover rate that I'm aware of in our industry. And we've got the highest financial outcomes because of the quality of what we do for our people and our clients. Now, the market opportunity is hundreds of billions, and we don't think that we can access that in the next 5 minutes. But we do think that in a relentless, determined Jim Collins long march way, we can probably grow an accounting firm that has a significant impact on our industry to make it a better place for people to work, a better service provider to our clients, and an organization that makes a positive impact in the community. The bottom line is the big four accounting firms are not accounting firms anymore, and they don't behave in a way that young people can really relate to or really want to enroll with. The second tier firms in all markets are running a 1950s model that has no differentiation and nothing to distinguish itself. And so there is this sort of blue ocean opportunity to have an insurgent approach that really changes the game on the industry. Now, there's a lot of people out there that might propose that they could buy a few accounting firms or fiddle around in some way, but we're not sure that there's anyone with a transaction of having, a transaction history of over 80 transactions that's built a business system from the ground up and has compounded their own capital and their investors' capital in the way that we have, the period of time that we have. And so it's not always true that Rafael Nadal will win every match that he plays in. However, it's more likely that somebody that knows how to win will continue to win than somebody that's never really known what they do at all. So that's the way we think about the business. We love Spain. I'm going to be in Spain in April for the McDonald's Global Conference in Barcelona. I think it's around the week of the 5th, 6th, 7th, 8th, 9th, somewhere in there, 7th, 8th, 9th, something like that. And a number of investors have messaged me on Twitter and said, I think one of the lads who probably listens to this is in Malaga, has said, hey, could we catch up? And I'm definitely open to having dinner with some people while I'm in Barcelona or in another part of Spain if it makes sense for anyone.
Okay, so I like to join if you come here, Barcelona or other part. So and if someday you are coming to Spain for searching accounting partners, please tell me before, right?
Yeah, that's what we're doing right now. I've had one of our shareholders has come to me and said he'll talk to some firms in Portugal, And there's another gentleman who's a shareholder who has said he'll speak to some firms in Spain. What we plan to do is share a model, which we will in the next few weeks. We think we've found a partner in one territory where we'll partner with a management team that wants to grow our model in their market. So if I can find a Spanish CPA or CA or person with the right values and background who wants to work with us to build out our model in Spain, then I'll definitely do that. And the reason is I've been to Spain a number of times. I've been all the way through the north of Spain to Bruges and to Santiago de Compostela into Madrid, and out to trying to think on the east coast by the water, beautiful for my paella. And I love the country and I'll be happy to be there. So, you know, if there's anyone that's interested, then just send me a DM on Twitter and you'll always get a response.
Okay, sounds really great. So, Brett, thank you for your time with us. Thank you for asking the questions, and we are in contact.
I appreciate it. And thank you to you and all of your listeners, and have a great day.
Bye-bye.
Thank you.
Bueno, espero que os haya gustado. Como siempre, esto solo lo vais a encontrar en este canal de YouTube. Por tanto, me hacéis un favor si compartís este contenido en vuestras redes sociales, ya que eso me ayuda pues, a que pues los CEOs como Brett pues, tengan interés en aparecer en una entrevista. Yo creo que esto aporta mucho valor. En vez de dedicarme a hacer clickbait, pues me dedico a traer CEOs al canal. Yo creo que esto es subir el nivel y, sobre todo, como veis, pues he trasladado, si no todas, casi todas las preguntas que me vais proponiendo, ¿vale? Mañana tenemos directo, por lo tanto, ya que hemos hecho esta entrevista, pues lo que trataré de hacer, si me da tiempo, yo creo que sí, es vamos a ver un poco por dentro las tripas de Kelly Partner y vamos a analizar pues la compañía, ¿vale? Por tanto, mañana a las 7:30 nos vemos. Ya sabéis que tenéis abierta la prelista, la sexta edición del curso avanzado, que empezará el 22 de abril. Quedan pocas plazas porque ya hay mucha gente que se ha apuntado a la prelista. La prelista te garantiza durante una semana, una vez se abre la matrícula, que tienes una plaza asegurada. Evidentemente, creo que hay un 90% ya de plazas cubiertas en la prelista. Este no es un curso donde hay 300 alumnos, porque dentro del curso se abren los micros para que los alumnos también puedan hablar. Y eso lo hace mucho más personal y probablemente es una de las dos diferencias grandes respecto a otros cursos. Uno, la facilidad de hablar conmigo a través del audio y que el curso es mucho más personal. Y dos, la profundidad. Este no es un curso para novatos, no es un curso para rookies. Si no tienes conocimientos de finanzas, de contabilidad, al menos mínimos, te garantizo o te recomiendo que no te inscribas a este curso. Te puedes inscribir al curso de Alex o de Fernando, que son cursos para principiantes, pero si realmente quieres subir tu nivel de análisis, este es tu curso. Te invito a que veas los testimonios. Tienes muchas opiniones, no subidas por mí, sino por los propios testimonios, y todos pues muy contentos porque adquieren un nivel de análisis muy elevado, y no solo en compañías típicas de FinTwit, de Quality Growth, Compounders, sino en todo tipo de compañías, value, deep value, rates, cíclicas, ¿vale? Enseñamos a analizar cualquier compañía, aunque no sea cotizada, ¿vale? Aparte de esto, también puedes hacer el curso 10K, que es un curso grabado, os podéis inscribir al club, que es formación continua, 2 veces al mes, 25 euros, entrevistas, tesis de inversión con modelos en Excel que yo mismo subo a la escuela para que los miembros del club los puedan consultar. Eso es novedoso, eso no se ve en otros clubs. Por tanto, si te inscribes al club, vas a tener acceso a los modelos, a tesis detalladas, a contraste de información, a entrevistas, a masterclass macro, micro. Vas a ver también temas contables, muchísimas cosas, ¿sí? Por tanto, lo dicho, nos vemos mañana a las 7:45, como siempre. Agradeceros las preguntas a los que estáis aquí. Marcelo, igualmente. Justamente hago esto para vosotros, para que preguntéis a CEOs, porque yo sé que eso no es posible. De hecho, yo ya hablo con los CEOs. No debería hacer esto porque yo ya hablo con ellos. Si lo hago no es por mí, sino es para que vosotros les podáis preguntar, sobre todo pues sabiendo que es difícil. Inversor lucense, un clásico. Gracias por estar, Marcelo. Por tanto, lo dicho, me despido ya y nos vemos mañana a las 7:45 y ponemos números a todo lo que nos ha explicado Kelly Parres. Un saludo, buenas noches.